Have you ever wondered what dividend stocks are and how they work? You're not alone. Many people are curious about this topic, particularly those venturing into the stock market realm. In this brief analysis, we'll investigate the nature of stocks, dividends, and the unique role of dividend stocks. Our journey will provide you with valuable insights into choosing these stocks, alongside a discussion of inherent risks. This tutorial is designed for everyone, from veteran investors seeking to broaden their understanding to novices aiming to grasp the basics. Our mission is to make these complex concepts digestible and empowering so you can make informed decisions confidently. Let's dive deep into the intriguing world of dividend stocks. Are you ready to embark on this journey of financial enlightenment? Stay tuned to find out more about the fascinating world of dividend stocks. Before diving into dividend stocks, understanding the basic concept of stocks is essential. We may ask, what are stocks? In the most straightforward terms, stocks are a type of financial instrument that signifies an investor's ownership in a business corporation. This ownership is symbolized by a claim on a portion of the corporation's assets and earnings. The concept of stocks can be compared to buying a small piece of a company. By acquiring a stock, you are essentially becoming a part owner or shareholder of that company. This entitles you to share the company's success story, be it profits or growth. But you might be wondering, why do corporations issue stocks? The answer is quite simple. Companies issue stocks primarily as a means of raising funds. Instead of resorting to borrowing from financial institutions, where they would have to deal with potentially high interest rates, corporations often choose to sell ownership stakes in the form of stocks. This method of fundraising allows them to channel the funds raised into various aspects of their operations, including launching new projects, expanding their business operations, or servicing existing debt. By issuing stocks, companies invite potential investors to contribute to their growth and success. Now let's delve into the two main types of stock that investors can buy. These are common stocks and preferred stocks. Common stocks often come with certain privileges like the right to vote at shareholders' meetings and to receive dividends. Dividends are essentially a portion of the company's earnings that are distributed to shareholders. Preferred stocks, however, typically do not come with voting rights. But they do have a higher claim on the company's assets earnings. In the unfortunate event that a company goes bankrupt, preferred shareholders are given priority, meaning they get paid out before common shareholders. Stocks are bought and sold on stock exchanges. These are platforms where potential buyers and sellers convene to decide on a price. Some of these exchanges are physical locations where transactions are executed on a trading floor, like the New York Stock Exchange. Others are virtual platforms comprising a network of computers where trades are executed electronically, such as the NASDAQ. To sum up, stocks offer a means for corporations to raise funds and for investors to acquire a stake in a company. However, as an investor, it's important to remember that you're not just purchasing a piece of paper or a virtual certificate. You're buying into a business, its assets, and its future earnings. Essentially, you're banking on the company's potential to grow and succeed. Now that we have a good understanding of what stocks are, let's move on to the concept of dividends. So, what exactly are dividends? Let's delve deeper into this fascinating topic. Dividends are, in essence, a company's way of saying thank you to its shareholders. But it isn't a thank you expressed with mere words. Instead, it's delivered through the distribution of cash or, occasionally, additional shares of stock. To put it simply, dividends are a fraction of a company's earnings that are distributed to the stakeholders. They act as an appreciative gesture from companies, sharing their success and keeping investors engaged. But it's not just an arbitrary act of kindness. There's a strategic rationale behind companies doling out dividends. By allocating a portion of their earnings back to the shareholders, companies create an appealing proposition for potential investors. This strategy helps raise additional funds for prospective growth and expansion, thereby ensuring future success. Dividends are offered in various forms. The most prevalent is the cash dividend. As the name suggests, cash dividends are straightforward cash payments made to shareholders. The amount of cash distributed is contingent on the number of shares you hold and the company's specific dividend rate. For instance, if a company announces a cash dividend of $2 per share and you hold 100 shares, your cash dividend would amount to $200. The second type of dividend is stock dividends. In this case, companies disperse extra shares of stock to their shareholders, increasing the number of shares you possess. However, it's worth noting that this doesn't alter the overall value of your investment. If a company issues a 10% stock dividend, you'd procure an additional 10 shares for every 100 shares you own. Moreover, some companies offer their shareholders the flexibility to choose between cash and stock dividends. This empowers shareholders to choose an option that aligns best with their respective investment strategy. Nevertheless, it's important to understand that not all companies distribute dividends. Certain prefer to reinvest all their profits back into the business for further growth and development. These are typically nascent or rapidly evolving enterprises. On the contrary, companies that are well established and have consistent profits are more likely to distribute dividends. With this comprehensive understanding of dividends, we can now delve into dividend stocks. So, we've talked about stocks and dividends, but what are dividend stocks? Let's get straight to the point. Dividend stocks, in its simplest form, are shares in companies that distribute profits or dividends to their investors on a regular basis. To put it in a more relatable perspective, imagine this. When you purchase a stock, you are, in essence, buying a part of the company. You become a part owner of the company, and as such, you get to partake in the company's success. This success is usually measured in profits, and these profits are what's distributed to you, the shareholder, in the form of dividends. One could compare the process to having a fruit-bearing tree. You purchase the tree, tend to it, and once it starts bearing fruit, you get to enjoy the benefits. The tree, in this context, symbolizes the company, and the fruit stands for the dividends. So, you might be wondering, why are dividend stocks so coveted? They hold a certain appeal, particularly for investors who are focused on generating a steady flow of income from their investments. These are individuals who strategically invest in dividend stocks to create a continuous stream of revenue. Dividend stocks are capable of providing this consistent income because they distribute dividends regularly. This could be on a quarterly, semi-annual, or annual basis. Imagine the scenario where you are an investor with a diversified portfolio of dividend stocks. Every few months, you receive a dividend payment from each company in which you own stocks. When you total all these payments, you end up with a significant income stream. This could either supplement your regular income or possibly be a source of finance for your retirement. But wait, there's more. Dividend stocks not only provide you with dividends, but they also have the potential to grow in value over time. Yes, you heard that right. Dividend stocks can provide dual benefits, steady income from dividends and potential capital appreciation. However, a catch. Not all companies distribute dividends. Some choose to reinvest their profits back into the business to fuel further growth. This is usually the case with younger, high-growth companies. Conversely, companies that are well established and have a steady flow of earnings are more likely to distribute their profits to shareholders as dividends. Dividend stocks can be a great way to generate income, but how do you choose the right ones? The question is valid, and the answer to that is a bit complex but essential. Stay tuned because in our next segment we'll delve deeper into how to select the best dividend stocks for your portfolio. Choosing the right dividend stocks can be a daunting task, but fear not, we'll guide you. As you embark on this journey, understanding the various facets of dividend stocks becomes crucial. It is similar to a puzzle, and each piece holds a certain value in contributing to the whole image. The first piece of this puzzle is the understanding of the dividend yield. This is obtained by dividing the annual dividend payment by the stock's current market price. The resultant value is expressed as a percentage. A high dividend yield might initially seem very attractive to an investor. However, a yield that is too high could indicate a company in financial distress, a potential red flag for investors. Hence, while analyzing the dividend yield, it is important not to get blinded by the allure of high returns. The payout ratio forms the second piece. This ratio signifies the proportion of earnings a company pays out to shareholders as dividends. A payout ratio of less than 70% is normally deemed sustainable. If the ratio is excessively high, it could indicate that the company is returning more money to investors than it's generating. This could lead to financial instability in the long run. Therefore, it is essential to keep an eye on this particular factor. The company's financial health is the third puzzle piece. To assess this, delve into the company's balance sheet, income statement, and cash flow statement. It is vital to determine if the company has a steady revenue stream, if its net income is on the rise, and if it is generating a positive cash flow. These are essential questions to ask. A financially healthy company is more probable to maintain its dividend payments over time. Dividend growth is another factor to consider. A company that consistently increases its dividends over the years is often more reliable. They are more likely to continue this trend in the future. Hence, this forms another piece of our puzzle. Sector specificity is another thing to be mindful of. Certain sectors like utilities and real estate are famous for high dividend yields, but they could be more prone to market fluctuations and economic downturns. Therefore, diversifying your portfolio with dividend stocks across various sectors is vital to balance out the risks. The company's dividend policy is another essential factor. Companies either have a policy of returning a fixed percentage of their earnings to shareholders or aim to increase their dividends each year. Understanding a company's policy can provide insights into its potential future dividends. Investing in dividend stocks is not just about chasing high yields. It is about understanding the company's financial health, payout ratio, dividend growth, and policy. It requires patience, as it is a long-term game that values the compounding of returns over time. Therefore, do your research and take your time to select the right dividend stocks. By considering these factors, you can make informed decisions about investing in dividend stocks. Like any investment, dividend stocks come with their own set of risks. Now you might be wondering, hold on, I was under the impression that dividend stocks were a relatively safer option to consider. Yes, in a majority of cases, they indeed are. However, it's crucial to understand and remember that no investment is without any risk, and this concept extends to dividend stocks as well. So let's delve deeper into some of the potential roadblocks and pitfalls that you should cognizant of while considering dividend stocks. The first point to note is the risk of dividend cuts or possibly complete eliminations. Keep in mind that companies are not under any mandatory obligation to pay dividends, and they possess the right to decrease or completely halt these payments at any given point. Predominantly, such situations arise when a company finds itself grappling with financial hardships or a downturn. A typical case in point would be the economic recession of 2008, when a plethora of companies decided to cut their dividends as a cost-saving measure. Suppose you are counting on these payments as source of income, this could be a massive setback. Moreover, there's the risk of market volatility. Similar to any other stock, the price of dividend stocks can experience fluctuations rising up or falling down. If the overall market suffers a downfall, your dividend stocks can also be affected negatively. It's essential to remember that while dividends can serve as a reliable of income, they're usually not substantial enough to compensate for a noteworthy drop in the stock's price. Another risk to be wary of is overconcentration. It's quite easy to be enticed by the charm of high dividend yields and eventually end up with a portfolio that's heavily concentrated in a single sector or worse, a single stock. This could potentially leave you susceptible if that particular sector or stock experiences a downfall. And last but not least, there's the risk of missed opportunities. By concentrating only on dividend stocks, there's a chance that you might miss out on growth stocks, which could potentially offer higher returns. It's always advisable to maintain a balanced and diversified portfolio, as it's the key to managing risk effectively. So, while dividend stocks can be an excellent addition to your investment portfolio, it's vital to always remember that they're not completely devoid of risks. By being aware of these risks and managing them effectively, you can make informed decisions about your investments. Being aware of these risks can help you manage your investment portfolio more effectively. Let's summarize what we've learned about dividend stocks. We've taken an extensive trip through the captivating world of financial markets, delving deep into the nuances of stocks, dividends, and ultimately, the compelling concept of dividend stocks. The journey commenced by comprehending the underlying bricks that make this wall, commonly referred to as stocks. These are, in the simplest terms, tiny fractions of a company's ownership. The action of purchasing a stock indicates that you are buying a small part of the company, thus becoming a shareholder and gaining a say in the company's assets and earnings. Our journey then transitioned to the realm of dividends. Dividends are, more often than not, portions of a company's earnings that are distributed to shareholders, typically in a regular pattern. It is the corporate world's method of expressing gratitude to their investors for their faith in the company's future potential. Dividends can manifest in various forms, including but not limited to cash payments, extra shares of stock, or even other types of assets. Upon merging these two concepts, we found ourselves facing the notion of dividend stocks. These are shares from corporations that have a consistent history of paying dividends to its shareholders. They're mostly companies that are well established and have a track record of profitability, regularly sharing the fruits of their success with the loyal investors. A lot of people find these stocks attractive because they provide a reliable income stream, alongside any possible capital gains from the increase of the stock's price. We then navigated the intricate art of choosing the appropriate dividend stocks. An important point to remember is that it's not just about the highest dividend yield, rather, it's about the sustainability of dividends, the company's future growth prospects, the payout ratio, and the regularity of dividends. Factors such as a company's financial health, its industry position, and the market stability play a crucial role in decision-making. Essentially, your aim should be to find a company that will keep paying you consistent dividends over a long period of time. But just like everything else in life, dividend stocks are not without their risks. The assurance of regular dividends doesn't mean the company is safeguarded from market volatility or financial challenges. There is always the risk that dividends might be reduced or completely eliminated if the company faces financial distress. Sometimes a high dividend yield could actually indicate a company in trouble, rather than a profitable one. Hence, critical to conduct thorough research before making any investment decisions. To sum up, dividend stocks could be a valuable addition to your investment portfolio, providing a source of regular income along with potential for capital gains. They do come with their share of risks, but with meticulous research and judicious decision-making can be an asset in your financial journey. Understanding dividend stocks is a stepping stone on your journey to financial literacy and independence. It's all about staying informed, making intelligent choices, and ultimately letting your money work for you. After all, isn't that what investing is all about?